Hello, so this is one of my fifth or sixth videos now, and we're just going to quickly go over what happened yesterday. So if you watched my stream, I reviewed the market till we were about, let me just have a look. We were about here when I ended the stream, and I said we're looking price to trade higher towards all-time highs. Hasn't got there, we got pretty close. This indicator that I showed you that said when we're at all-time highs, when we're at the end of the daily range, was about here. Admittedly, it did go a little bit further than that, but this just gives me a rough idea of when we topped out. As you see, for the rest of the day, it did sort of consolidate around. So yeah, if I got out here, which is when I would have, then here or here, I would have probably got out, and then it would have just chopped around for the rest of the day. You wouldn't want to be involved with that once we hit that 5-day ADR to the average. So if you think of the average range over the last 5 days, this is the indicator that tells you when it's at a 5-day average daily range. Don't really know how to explain that one, but again, it happens on this day as well. We hit the 5-day average daily range and it doesn't travel any higher. That one's a bit of a better example. It's just not worth, it's basically indicating to me it's not worth going in expecting much higher, to be honest. Okay, so there's that indicator that I just wanted to show you, and it's this one. So you want to, first thing to do as a beginner is download TradingView. So I'm going to start from very basic. So some of my videos have been a bit complicated, so this is the one I'm going to start with now. That is for beginners. Okay, so for someone who's never looked at a chart before, this is the video you start on. Okay, so yeah, pay attention if that's you. There's this indicator. I just wanted to recap over the last live stream that I did, okay? Because yeah, I wanted to recap and just prove to you my point that I said it was going to go higher, and then it did. Okay. Now I can delete this indicator. It is, it's this one here, ADR. I'm just trying to find it for you. So when you go onto your indicators tab at the top here, you have 5-day ADR ICT intraday tracker, and that's the one I'm using. So yeah, click on that. We have a list of all the other ones that I use here. So trading sessions. So you need to understand what all these indicators are as well. Okay, but I'm not going to go through that all in this video, because all of this is probably a video in itself. Okay, meaning why would I bother putting these on the chart, these little things? Okay, so all of these are videos in themselves, but be mindful what I teach you today. You're going to progress and start using these or marking them out yourself like ICT does. I'm a bit lazy in that regard. I don't mark them myself. Okay, but I just find it easier if I don't mark them myself. Pretty much I know what they are, so I don't need to do it. Okay. So right, where do you start then? So let's remove all the indicators off. If you press the little eye icon, it just removes them all. Okay, and then we can just delete this with the little bin icon here. And then I can remove all my drawings. So the first thing you need to know if you're trading and you're looking at a chart is you have multiple time frames. So how you would know what time frame you are on is up here. So you have 1 minute, and you have all the way down every different time frame there. When you are trading you can use multiple time frames to flick through. For example, if I go into the 15-minute, every candlestick, so these are called candlesticks, every candlestick represents one 15-minute block. Yeah, so that's the main thing. So as well as that, you want to see about what is a candlestick. So a candlestick represents how price fluctuates over the time frame that you're on. So if you're on the 15-minute time frame, this candlestick represents how price fluctuates over that amount of time. Okay? So in regards to it, every candlestick has an open, high, low, and close. I'm going to write this down as we go through. Every candlestick has an open, high, low, and close. Okay? You can change the colours of these candlesticks. I go for green and black just because that's what I've always done. Let me spell that right. So I'm making notes for you as we go along so you can copy as well, so I'm not missing anything myself. Bullish candle are when candlestick prints higher. So if you look at the green candles, that's when the candlestick, so the open is the bottom of it, yeah, and the close is the top of it on this candle, yeah. So that's what you call a bullish candle, yeah. Bullish meaning higher. So in the markets, you've got bulls and bears. A bull is someone who you think price is going to go up, or you've got an upward candle. That's a bull market. So everyone says when you in the stock market, if it's a bull market, we're going up. Yeah, so like for now we're in a bull market, stocks are at all-time highs, so we're in a bull market. Okay, doesn't mean you have to trade bullish, yeah. So bullish candle when a candlestick prints higher. Bearish candles are when a candlestick prints lower. Okay, so in regards to that, what does it mean prints lower? Well, if we go to the 1 minute chart, I'll go back to that thing. It's currently trading lower than when it opened. Okay, so if you have a look, then it closes. So it opens, it's trading up. And if it closes higher, that'll be bull. If the candle closes lower, that'll be a bearish candle. Okay, so back to the 15-minute chart. I think that explains it. So the open is there on the bullish candle, and the close is there. On a bearish candle, the open is here, and the close is here. Okay, makes sense? And then you've got the high and the low, which are where the wicks are formed. So the bottom of the wick is the low, and the top of the wick is the high. Okay? Does that make sense? So, bottom of the wick. So we opened, traded lower, formed the wick, traded higher, formed the high, and then closed a bit lower, forming a bullish candle here. Okay? As long as you know that, you know the market's going up or the market's going down. The two key concepts to start with is looking at the open, high, low, and close. Okay? So, where can we go from here? Well, you need to understand market structure. We won't go through all of that in one video, but I'll just introduce the idea of what it is. Market structure is when you look at the formation of candles. You look at the formation of candles to predict what's going to happen. Okay, so that's the next thing. So market structure, when you look at the formation of candles of what's going to happen. So for example, I could assume price is going up, coming down, and it's going to trade higher. So that would be me looking at market structure, and then we're deciding what's going to happen from price. Okay, so see we've been in a bull trend, and this is a bear trend. Okay, I'm teaching you from the very basics here. I'm trying to not go too far ahead. So you want to buy stocks, or what I'm trading is futures. That's probably where I should go next, of what we are trading. Futures or commodities or whatever it is at a discount price. Yep. You want to sell stocks, futures, or commodities at a premium price. So you've got to know what the trick is. When we go through this course, you will be able to know what's premium and what's not premium, what's discount and what's not discount. Okay. So the next thing is deciding to pick one thing to trade. Pick one instrument to trade. So they're called instruments. So you could choose the Nasdaq, which is what I'm on now. When you are trading with low money, it's a micro. So micro, Nasdaq, S&P 500, which most people know about. These are futures. Or you have Forex, which is foreign exchange. So you could buy, for example, the pound against the dollar, anything like that. You could have Japanese yen versus the dollar, yen versus the pound, the Aussie currency. Yep, so you've got lots of different currencies. I stay away from that, but I'm just making you aware. The concepts apply to all of this. Okay, so you want to pick one instrument to trade. Specifically stick to that, yeah? Specialize in that one market. The next thing after that I would say comes is you have risk management. So no matter how good or bad you are at trading, risk management, and whatever method this comes for people who have doing really well at trading, people who aren't doing well at trading. Risk management plays a massive factor in that. So what I mean by risk management is that you want to have a good risk to reward. So we call it positive expectancy. Don't know why I'm typing in capitals now. Positive expectancy or positive RR. So if you go to the left of your chart in trading view, you have long position, short position. So for example, if you're buying when you click on it, it says your risk to reward ratio. 1 second. So risk to reward ratio. So you want a positive risk to reward. So positive risk to reward is when you're risking, say, £100 to make say £300, yeah? Trying to get that exactly on rate. And it tells you your risk to reward ratio, roughly like that. So you want lower risk to bigger reward, yeah? So that's the main principle that comes across in trading. So be mindful of that. A long position I'm teaching you what you need to know before we get into what to do. Yeah, so I'm teaching you what you need to know first, and then we'll get in what to do. Okay, so two separate things. A long position is when you buy. You buy. Yeah? So this is a long position. Short position is when you sell. So that would be bearish. And when you buy, you're bullish. So your outlook on the market is you think price is going to go up, yeah? Obviously, you wouldn't buy if you thought price was going to go down. Makes sense? So we're good so far. Next thing you do is what you need to have practice. So trade on a demo account. For example, TraderBait that connects to TradingView. TradingView is this platform we're on that allows you to draw a lot of things on the chart, things that are useful, key levels, things that we're going to talk about, that we look at. So always use something that connects to TradingView. So I'm with TraderBait demo account here, the balance is here, and when you enter a trade, it will connect to TradingView, and you can do all your charting, see the profit and loss, etc. Okay, so they're the main things to begin with. So I take a screenshot of that or write it down. Hope this makes sense to everyone who's new to trading, never done it before, and then we will get into the way you start to look at the markets now. So not actual trades, but the key things that you need to know about the market. Okay, so let's move this here. So this is all information, the starting blocks, if you like. Let's make another box. I'm gonna move this out of the way a little bit. So we'll come down here. Next thing you need to know is markets are not determined by people buying and selling. So that is not what dictates where the price goes. This is where we're different. This is where you start to be different from everyone else, by thinking in this way. It's the mindset that you need in order to be profitable. Because if you were to assume that it's a free market, then you're gonna assume, for example, loads of people are buying, let's buy. Yeah? But that's not how the markets work. If loads of people are buying at a specific level, that's actually probably a bad thing, because the market's going to want to come back down to that for liquidity. So volume is not important. So volume is irrelevant. price is important. So what price we're at. So the next thing is if you've ever used indicators or like trend lines, for example, they're nonsense. Okay, so that's the next thing. Unless you're like an algorithmic trader who's done, like, hard to explain, but if you're an algorithmic trader that has programmed it over years of data to sort of take a small edge out of that, then it can work. But for what we're doing, indicators don't work nowhere near as well as this. Potentially you can get lucky and win off an indicator, but they don't work. All you need to look at is the chart. Okay, that's the next thing. Anything that tells you past data other than the candlesticks is irrelevant. So for example, if you're looking at the price and see loads of people bought at a specific level, that's the past. Yeah, the past in terms of indicators, in terms of like relative strength index, in terms of volume, all that's irrelevant, because I'm not interested in the past. I'm interested in the future. Okay, so as a trader, you are trying to predict the future. Okay, so you're trying to predict the future without looking at past nonsense things. Okay, the candlesticks are what you need to look at. The candlesticks and other things we're going to go through. Okay, so you're trying to predict the future. We're going to look at PD arrays to do this. So PD arrays are premium and discount arrays. Notice how I'm coming back to that term, premium and discount. So if you went to the shop, you would want to look for yellow labels and you get something at a discount price. Yeah, if you were to sell something, you want to sell it at a high price, so this is premium price. Yeah, so you're always trading between premium and discount to do this. I'm trying to go one step at a time so I don't go too much into it. I predict this might be slow for some people, but just go through it at like 2x speed. It's fine. If you've heard this all before, just go through it 2x speed. Make sure you know all this, and then skip to the next video. Yeah, can't be fairer than that. So you're looking at PD arrays to do this. The main thing now, haven't mentioned this yet. The markets are determined by an algorithm. So what I'm saying in that AI is now, what I'm saying, which you might not believe right now, but you will start to believe the more you watch the videos, is that price came down here because the algorithm told it to go to that specific level. Okay, the market came down here because the algorithm programmed it to go down here. Regardless of how many people buy or sell there, the algorithm is telling the market where to go. Yeah, so you're like, no, that can't be the case. If that was the case, they could just make it go wherever they want. Yeah, that's the point. This is why 90% of traders lose. So 90% traders lose because they don't believe markets are run by an algorithm. So what are the 10% of the traders that win? Well, in that case, you have smart money. Smart money and smart money concepts are traders that aim to take the losers' money. Yeah. So by saying that is, so you want to target where 90% of people have their orders. Yeah. So target where the uninformed money, which is the retail, so retail concepts are bad. Traders have positions. So a position is where they entered, yeah. So say I entered here, yeah. Or say, for example, here's a better example. Retail traders see this as a trend coming down. Okay. So they are positioned up here. And as the order comes down, they might, for example, move their stop loss. Yeah. Down here, thinking it's going to further go down. So that's another thing I need to talk about: stop losses and take profits. Okay, we'll go through that. But so smart money will be aiming for these areas here, and then price goes up, takes them areas. So you need to have that belief system, yeah. Target where the uninformed retail traders have positions. But then you might be thinking, how do I know that? This is what we're going to teach you in maybe this video, if you stay long enough, or the next video, depends on how far I get. Up here, the key box again. This is the important information. There, you need a stop loss and a take profit. So going back to that example before, if I entered on this line here, that's my entry, that's my stop loss, and the take profit is where you decide where you put your take profit and your stop loss in advance for the trade, yeah. So before the trade takes place, you decide where you want the stop loss, where you want the take profit to be, and you need to know where to enter, you need to know where to put your stop, and you need to know where you're going to put your take profit before you enter the trade. So 3 things, and you need that positive risk to reward, hopefully, yeah. Break even is if you move your stop there and it comes up, hits your stop, and you don't make money, you don't lose money, okay? Not the end of the world, right? Again, saying again, neither is a losing trade. If you have bigger risk to reward and you're winning more than you're losing, you're going to make money. So you don't need to be perfect. That's the next point. You don't need to win every trade to make money. You don't need to write that down. So, smart money, for example, like banks, institutions that are targeting people's order, that have like really advanced traders, they're trying to target the retail traders' money. So retail traders have beliefs in what they believe price is doing and what causes it. So if you've ever read a book on trading, you might see support and resistance being one. For example, let me see if I can find a level, and typically they don't hold up very well. them on the 15-minute chart, it's a bit hard. It's we're new. So it's like a channel, so for example, like these tops here that touch the same, I'm trying to find almost perfect that, there we go. So, get a trend line. If you click here, the trend line, if you press the shift button on your computer and draw it, it draws it straight, okay? So, key concept that retail traders, I'm actually teaching you retail because the reason I like to know a bit about retail is because we want to do the opposite of retail. So if we want to do the opposite of retail, we need to know what retail are doing, yeah? So when you have anything like this, where it hits the top, retail think this is a strong level to come down. And sometimes it works, but not, you can't predict that's going to happen, yeah? That's the key with retail, you can't predict anything off it. So they believe that this is going to come down off this, what you call resistance. See if I can find support. Again, like here, they believe this is a strong area. If you have a look with both examples, comes through it. Again, it's not predictable, as you can see, it comes through it. The more you try it, you'll find out it doesn't work. No one's profitable using this stuff. If you are, you're incredibly lucky and it doesn't work, okay? My opinions from learning how to trade, following my teacher ICT. So yeah, that's the next thing. So for example, another one is trend lines. Again, believing that trend lines are very old price, but then for some reason the trend line breaks down. Again, I'm not trading off trend lines ever, okay? Don't do that. It's not predictable. It's not what price is doing. Obviously things have a trend because price has to move, yeah, in one way. But you can't predict the future of the trend, so it's irrelevant, okay? So get all these ideas out of your head, because trend lines don't work, or they can't predict it. You can't if you have a trend line, you can't predict when it's going to go through, basically just looking at trend lines. However, what I'm telling you to do is we're going to look at smart money concepts that is going to predict when price is going to like turn around, where price is going to come up to and then down. But I'm not using trend line for that. We're using price delivery arrays. Sorry if I'm boring you, but this is the basics, and I wanted to have a video of the basics because I was watching one of my videos back with my mum and she was like, no one's gonna understand this. I was like, well, no person who's a beginner is gonna understand this. No, they're not. So I thought, well, why not make a video for I can direct everyone to that has never traded before, never looked at a chart, so they're not going to be confused. And this is that video. Okay. So it does help if you know a bit about retail trading. People who trade retail concepts most likely not profitable, to be honest. Anyone can get a bit lucky, have a lucky streak, and if price is just going up, anyone could, for example, get lucky and win. Yeah? But over the long run, no, you won't win. So smart money is where we align our trades with. So you need to know where other people's orders are. So the first key thing now, we're getting into the trading thing. am I happy to delete this? We'll leave it on this slide. We'll go to a 5-minute chart. So this is like a day. So we'll talk about futures. Sorry. A bit more. So you need your chart. Set to Eastern time, which is down here on TradingView. When you click here, sorry, no, Eastern time. So we'll talk about time. That gets me into another thing that I've missed. You need it in Eastern time, New York. Yeah, always New York, no matter where you are in the world. New York time. Algorithms. Can't even spell it. Stop. The market runs off New York time. This time. Okay. As well as this, you need to know. There's so much to go through, honestly. I'm just trying to go through in a logical order. So you press this button down here and click whatever says New York, no matter where you are in the world. Done. On to the next thing. So markets open at 6 p.m. Eastern time, close at 5 p.m. Eastern time. So how I can show this to you is this. Where the blue line is starts a new day. So this last candlestick here, if you look at the time in the black box at the bottom, down here, that last candlestick is at 4:55. So it's the last candlestick was 4:55 and it closed at 5 o'clock. The next candlestick opens at 6. So there's 1 hour where we're 1 hour non-trading. So this would be electronic trading hours. Then you're like, well, what do you mean electronic trading hours? We'll get into that now. Electronic trading hours, you can see down here. So that's electronic trading hours, 6 p.m. till 5 p.m. the following day. So you're open 23 hours of the day. Regular trading hours, slightly different. So we'll do the same thing again. I'll see how I've clicked down here now. Switch from electronic to regular trading hours. Regular trading hours are from 4:15. So we're on a 5-minute chart. It says at the top. So the last candlestick is at 4:10. So it closes at 4:15 and opens at 9:30. Okay. So you need to make a note of this. Market opens at 9:30 Eastern time, regular trading hours, closes at 4:15. You need to know this because things happen at certain times. So what determines when the markets go up and down is time and price. Okay, so two things. And that should be in your keynotes as well. I'm going to make time and price are both important. So things typically happen at a certain time. Things typically happen at a certain price. Price level, price PD array, price delivery array, premium discount array, same thing. It all means the same to me. So for example, at 9:30, big movement. Same again, 9:30, big volatility. 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 So a lot of volatility comes in the market at 9:30. See the big move, 9:30. Again, the candlesticks are much bigger, yeah? There's a lot more to this, by the way, which we're going to talk about. For example, macro times. I've just dropped that in there, but we'll go through what these are. I also want to make you aware that I didn't make these concepts. I learned them off someone else, which is called ICT, who also teaches, and you should check out his channel as well, because he's got a lot of information on there that's amazing, and it's how I've learned to become a profitable trader. Okay, is by learning off him. So I'm just teaching you in my way what he's taught me. Okay, so you should be aware of that. I don't want to take credit for that. I just want to help people learn and spread the joy. Okay, so the gap. I'm just going to delete all these boxes now. Take a photo of that if you want. Don't know why I keep doing that. Queen 5 and 6. Sorry, yeah, 5 and 6 p.m. is a new day opening gap. Yeah. Between, these are things you need to remember. 4:15. Sorry, have I said that right? Yeah, so the gap that, so we'll go back to electronic trade now and I'll show you. Go to all modes, please. Here we go. That is a gap. I'm telling you because they're important. Yeah, else I wouldn't tell you. So 4:55, so 5 o'clock or 6 o'clock forms a new day opening gap, and that comes to my first indicator. See the lines drawn? Extend them through time. Okay, so where time and price meet us together, that's when we're gonna take our trades. If it's a Friday to a Sunday, when the markets close over the weekend, like that down. So they close and then open back up on Sunday at 6 p.m. and they close at 5 p.m. on Friday. You have the new week opening gap. So I think this is down here. Typically they're bigger because there's more gone on over the weekend. Price, a lot of things has happened, so price can have big gap. Yeah, again, that's useful to delineate through time. So that's called the new week opening gap. So Friday through to Sunday, and I have that on an indicator. Price can gravitate towards the gap. So down here, the gaps up here, they gravitate towards it, but there's more to it than that, which I'm not going to teach you right now. I will write it down and for you to take notes. Between 4:15. Sorry, I've done this already. The next one is between the regular trading hours, also has a gap. Okay. These ones are typically easier to spot because overnight trading's happened, so prices would have moved away. Sorry, what am I doing? So I'll remove them off. 4:15, 9:30. This is called your opening range gap. And just a quick concept, if you look in it, when you get to 9:30, price tries to fill in the gap most of the time. It doesn't here because the gap's big, which we'll talk about. When the gap's not massive, even though that's massive, this is 5-minute chart, so that's a lot of profit. Gaps, to give you the statistic, you can back test, and which we'll go into how to do that as well in a separate video, is 70% of the time, 50% of the gap is traded through by 10 o'clock. Okay, so that's your key. So by 10 o'clock, 50% of the gap is traded to. 70% of the time. That makes sense? So that's the first thing I'm going to teach. So that is called your opening range gap. Writing this down for you because it's quite not hard. I'm not saying it's hard to understand. It's just something you don't want to forget, which is why anything like that I'm just popping down. Because a lot of these things when I started learning went over my head. I'm telling you what's important to know. So between 4:15 and 9:30 regular trading hours gap is called the opening range gaps. And this would be electronic trading hours gap. I typically use an indicator that tells me the opening range gap. So for example, so I can stay on the electronic chart the whole time. So this is an opening range gap, but when I trade the 9:30 open, I'm always trading off electronic trading hours. Okay, does that make sense? So we trade on electronic trading hours, but it doesn't mean that gap's not important, because it is. So the opening range gap indicator I have here, so this was a very small one, so I won't show you that example. So here, yeah, so I'm, for example, in the market, might be in the market before this on the electronic trading hours, but I'm mindful that price might draw into this by 10 o'clock into the middle here. Okay, does that make sense? Yeah, let me just take a break. I'm going through it quite quickly, so you probably might need to watch this once or twice. If you've learnt ICT concepts, you might not even need to listen to this lecture, but I want to make sure it's here just so we have it for everyone. And again, this is a good indicator because it tells me that 4:15 price here and the 9:30 price here on the electronic trading chart. So you can go to indicators, type in all this, and then put it on. Okay. Okay, so I want to talk about kill zones. I want to talk about the different sessions as well. So there are 3 sessions, 3 different times that you can trade. But you can trade all day if you want to, but you're not going to. You're going to pick a session. or you're going to trade a couple of sessions, or you're going to just do a couple of trades in the day, or no trades, you're going to pick a session to trade. So let me just show you this as well. So this is Wednesday the 27th of May. If you go back to regular trading hours, Wednesday the 27th. Day did I say it was? Wednesday 27th of May. Yeah. Sorry, it's a bit far through. So that, see on the regular trading hours drop. On the regular trading hours it looks like that, filling in that gap. On the electronic trading hours, it looks like this. Okay, it's the same chart, but it's again where the stock market opens in New York for like the big banks and stuff. That was the regular trading hours. That's why they trade between a certain time, and then there's after time, and different parts of the world trade sessions at different times. Yeah, so you need to understand that. So you've got Asia first, Asia, then London, then New York. Okay, and that I'll remove this gap now, and we'll go back to it. We'll go off the opening range gap, so we'll get rid of that indicator, and now we want to look at the sessions. What I'm indicating here is the key session kill zones. So these are kill zones. By kill zones, it means the ideal times to trade. Okay, so where the best moves happen in the kill zone. Yeah, it doesn't mean it's the full session. For example, Tokyo trades further in. Yeah, so it's further across. You don't need to know like this. Like you don't need to know when Tokyo finishes, whatever. You just need to know when the kill zones are. Most importantly, so in the Eastern time, always talking about, you have 7 till 10 Asian kill zone, 2 till 5 London kill zone, 7 till 10, write this down, is New York kill zone. Okay, so 3 kill zones, so 3 times in the day where I'd say put your bet on that to be the best time to trade. But then you also have what you call dead time, times you wouldn't trade. So typically you wouldn't trade after 10 till about 12. Yeah, I'd call that a dead time, so make a note of that. 10 till 12 p.m. and again 5 a.m. till 7 dead time. Typically, not much happens in that time. You wouldn't bet on it. So here we go, 10 till 12, not much happens. 5 till 7, not much happens. Here we go again. 10 till 12, again not much happening. So I'm not saying every time nothing happens, but I'm saying your ideal, your typical scenario is that it doesn't happen again. 10 till 12, not much happens. Again, 5 till 7, I've got the move, but generally speaking, that I'd call them dead zones, as in like it's not the best time to be in the chart. You can see that we've got more movement in other areas compared to that. So I'm telling you the kill zones, and I'll just get this up. Trading sessions. Make sure you set the session time zone. It will either be UTC -4, or depending on what time of the year you're on, it could also be UTC -5. It all goes on about, you know, when the clocks go back, stuff like that. So be mindful of when that happens as well. Happens once or twice during the year, but you'll see, because this will change as well, and you can just Google it. I don't know the dates off the top of my head, to be honest. So I'm just showing you the times. So Tokyo or Asia, same thing, 7 till 10. London, 2 till 5. New York, 7 till 10. Kill zones, ideal time to trade. Not every day. And then, so they're your kill zones, not your full sessions, but your kill zones. I don't think how much more I need to cram into this video. How long have we been going for? I'm going for almost an hour. Covered that much, have I? Yeah. I knew this would happen when I just go ranting on about. So I'm trying to dial it back for people who've never traded, stuff like that. Because yeah, first video, let's get through the basics, and then we'll crack on to the more cool, fun, how the hell do I make money kind of stuff. But time and price are key. So when we hit a certain level, for example, London lows at macro time, which I'll get into in New York, we make this New York kill zone, we make that good trade up. Macro time in New York, trade down. So macro time is the first 10 minutes of every hour and the last 10 minutes of every hour. Yeah, so say for example 9:50 or 10:10, that's a macro time. Whilst we're also talking about time, you have the London close. So even though, for example, the London kill zone is here, 2 till 5, the London close is 10 till 11. So people will either offload positions on the London close, or it might reverse in the London close, depending on what's happened. So that's key time. Lunch starts at 11:30. So this is New York lunch, 11:30. So this is again, if there's no setup in this time, you might find something at lunch. 11:30 till 1:30. Again, you can trade it. A lot of the time it's a continuation. Sometimes it's like this, and sometimes it's set up. This is when we look at other factors, whether we do this or not. Okay, makes sense? But you need to know about the key time. So when I talk about time in other videos, you know when this time, when I'm referring to, when I say, oh, we're in the New York PM session, I'll be like, what's that? It's between 1:30 here. See how price starts to clean up till the end of the day, which is 5 o'clock. Yeah, so 1:30 till 5 PM session. Lunch 11:30 till 1:30. London close 10 till 11. Yeah, or 11:30 you could say. They're the key times that you need to know about. So you got Asia, London, New York, London close, lunch hour, New York lunch, and then PM session 1:30 till the end of the day at 5 o'clock. Okay, so the market, key things happen at specific times, so we need to know what times those are. Okay, so you've got Tokyo, London, New York, key aspects to the trading. So next thing, I'm going to introduce you to where market's likely to go. So when you look at any chart, the thing you need to first pay attention to is where is price smooth. Okay, so for example, when you have smooth area like this, price is likely to go up to that. Yeah. What we were saying before about retail traders. Retail traders may look at this as a strong area, whereas I'm looking at it as weakness. So smoothness is perfect to target towards the smoothness. If it's jagged, that's where smart money are. So for example here, if it's jagged, that's where smart money is, and the price is going to move from that. Smart money offloading positions here. Okay, look at the smoothness here, smoothness here. Okay, try and find some better examples. So I'm going to talk to you about liquidity sweep. So liquidity is where orders are. So I'm just highlighting key areas of what happens to that people take liquidity. Price targets above old highs and targets old lows, singular low. And I'm just going to go back through my chart and just do loads of examples where this has happened. This is a 5-minute chart. Okay, up through the highs, down through the lows. Through the lows. For example, uninformed money, see this going up. Buy, buy, buy. Smart money taking out their orders and going up to the other high. Yeah. You want to try and target relative equal highs. So, and this is where you start to train your eyes. So this was in consolidation, yeah, you would want to trade this. Don't trade consolidation, that's another thing. So you can have different market profiles, which we'll talk about in a minute. So relative equal lows or relative equal highs are when you've got, for example here, a high that the high on the right is lower than the high on the left. They're called relative equal highs. Go back, look through your chart of key instances where you have relative equal highs. For example, it can come back to a singular low because you're looking at what's happened previously. So if price has been trending up all morning, the algorithm sees that as inefficient. So it's seeing loads of people making money and it seeks liquidity. So liquidity is what is by meaning of where the orders are. So where are the retail orders? that's where the market is liquid. That's where price wants to come down to, taking the money away from people. Yeah. So it's balancing out the orders. There's an order book, so you've got buyers, sellers, and they're looking to get orders to next orders, get orders to the next orders. So that's another thing. So when you have relative equal highs that are smooth, it's likely to go up to that. When you have trend line, for example, like this, and a lot of people have made profit, you're going to look to target here. But then if we've targeted there, we've got the liquidity, then where's it going to go? Smooth areas, relative equal highs. Okay, so this is where you need to start training your eyes. This is the basic concept of liquidity. This is what you call a liquidity sweep. But you could look and say to me, well, why didn't it come to this relative equal low? This one is higher than this one. Well, it might do, just not today. Yeah, so this could be a key area if we believe price is going to go down in the future. Yeah, but it's taken out this and then gone higher. Okay, so a market can either consolidate, expand, yeah, consolidate, expand, so everything starts with consolidation and then expansion. Consolidation, expansion, reversal, reversal. Different market conditions. So if price is going to come down, how do you know how far it's going to come down if it's not going to come all the way down to these, for example? So then we start looking at things called, start making notes, called inefficiencies, yeah? And this is where you start to learn about inefficiencies. So let's really zoom in. I'm going to go in really far so you can see. So you know there's candlesticks, you know you've got the high, open, low and close. So this is the first concept that we're going to look at. It's called fair value gaps. So what is a fair value gap? There's 3 candles. So notice on this candle, there's no gap, no gap. Then all of a sudden, the wick high of candle 1, yeah, the wick high, doesn't touch the wick low candle 3. You have 1, 2, 3 candles, and that's called a fair value gap. So when you get your little box thing out, that's what you call a fair value gap. I picked a bad example because how you should actually draw it, like that. You want to incorporate what you call a volume imbalance when the candle bodies, high and low, don't touch. See how these touch? Volume imbalance, volume imbalance. And that's another PD array. So we've got 2 PD price delivery arrays here. So when price comes into that, it goes higher. And again, when price retraces, comes into that zone and expands up. Okay, I'm not saying every single fair value gap will work for this. You have to know other things as well, which we'll go into. This is one concept and you're on your way to start learning. Okay, so fair value gap, incorporate the volume imbalance in the fair value gap if there's one there, but there isn't on all of them. For example, this one up here, there's a tiny one. See how it comes into it and goes higher? Okay, that's your typical fair value gap. Zoom in so you can see. The wick of candle 1 high doesn't touch the wick low of candle 3. It's low. Okay, and that's a key thing that happens when price comes to rebalance. So if we're talking about retracements, which is when price comes retraces down and then continues higher, you want to look for fair value gaps. Other things called order blocks, which we'll go into in another video because I feel like it's going to be too much information else. So retracements, where were we? So if price is going up, you want to see it respect that the fair value gaps. Same again on the way down. Now price comes to come down, you want to see price respecting fair value gap the other way. So there's two types of fair value gaps. You have what you call a SIBI. So this one's called a SIBI, a sell side imbalance, buy side inefficiency. So price is inefficient, meaning there's been too much selling going on in that area. So price wants to come down back into that. Okay, does that make sense? And then go down. Whereas on the way up, we've had buy side imbalance, sell side inefficiency. So sell wants to come back down into that. And again, that's a key area to enter. When a fair value gap is disrespected, for example here, where you could say, oh, but this is a sell side imbalance, buy side inefficiency, is SIBI. So shouldn't the price gone down? Well, no, because you need to look at other factors. Not every fair value gap works like that, yeah? This is called an inversion fair value gap. So, but if price trades through that, then you expect that to act as another level. It's the real version of support and resistance that retail will not look at. So this is the real key zones, as you like. Again, see how now we've reversed. We reversed from this inversion fair value gap, and then got BISI. Just highlighting loads here. SIBI. Price comes into it, down. SIBI. Price comes into it, down. Inversion fair value gap. Comes up. Back into the SIBI. Comes down. Inversion fair value gap. Price trades higher. BISI. 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 So you're trying to buy when price is moving down, and you're trying to sell when price is moving up. Yeah, that's key to get the best price. Okay, let's go for it. Okay, let's talk about order blocks. So an order block is the last down candle before upwards move. So for example here, you could look at me like, well, this is an inversion fair value gap, so why didn't price just trade up from there? Because it used this as an order block. So if you were to extend this through time here, see how price touches the order block within a fair value gap, and it goes down. And what does it react off? If you have like multiple candles, like there, last two candles. Sorry, we should have this. I didn't see that one. The last down candle before the upwards move, that's an order block. And look how price reacts. Again, it looks quite complicated to start with, but I'm just going through how you can look at getting into trades at so at key levels, which we'll go on about in a minute. Say for example you think price is taken out some highs here. You think price is going to go down to target relative equal lows, which we've said. So it's taken out all them orders above here that were short, taken out all their orders, and everyone has got their orders here between your relative equal low, comes down, takes them orders. So on the way down, you can look for BISIs and CIBIs to act as key levels. Another PG array that I'll give you is when you have two bodies of the candles that overlap, so the high and the low. You see how price reacts off that? Bodies of the candle overlapping. See if I can find another one. I think I saw some like back over here somewhere, quite a lot. It's how you look at every single candlestick as key. Here, you see it, and it hits it, goes higher. With a fair value gap, if you are bullish, so we've talked about that, you don't want to see the candlestick bodies close in the lower half, but especially not below the lower half. So it might completely rebalance, but you don't want to see it close down here. You want to see it, if we're extremely bullish, stay in the upper half, but not, we don't want to see them close in the lower half. Okay. I'm teaching you a lot of stuff for the first video, so if you're not getting anything, it will make more sense as we go through. Again, at the moment you're just learning the basics. Yeah, so you're thinking, well, why did it come down here then? Well, that's the wick. ICT always says wicks can do the damage, yeah? So you've got to give your stop loss plenty of room. So with a fair value gap, always have your stop loss below candlestick number 1. That way you will be safe that it doesn't wick you out. If you went here, you lost the trade. Always have it below candlestick number 1. And that's the same for the reverse. So look at this, it's exactly the same thing. Candlestick. And again, like your stop loss isn't hit, but if you go down to candle 2, you get hit. Makes sense? So we're saying back to order blocks. Order blocks are the last down close candles before the up move. The last up close candle before the down move. You might get like a reaction off that. Again, reaction. That's another PG array. We talked about overlapping candles here. Reacts off, goes higher. So we're looking at every candlestick as information, and it's predictable. We'll talk about one last concept, and then I want you to just make notes and just go through and identify key highs, key lows, identify on your chart key highs, key lows, identify BISs, identify SIBIs on your chart. Go through and just draw that. We'll just talk about premium and discount, and then we'll call it a wrap. So premium and discount. There we go. So in order to determine whether something's in a premium or discount, you need to identify a dealing range. Okay, does that make sense? So by that, you need to identify the high and the low. So say price is traded higher, that's your dealing range. Get the Fibonacci tool, which is here. So go onto your trading view, draw it. You can set your different levels. What I've got set on here is something I'll go about in another video, and I've gone past in the last video as well. I went through this. If you want to click back, you can. Is you want 0.5, 0.75, 0.25. So every time price makes a new high, you're basically moving that. So that's your new dealing range high. Yeah. So that would be a dealing range. So dealing range, then you got your dealing range, then you got your dealing range. Okay. So the top half of the dealing range is what you would call premium, and the bottom half of the premium range, dealing range, is called discount. So you can imagine you only want to buy in a discount, you only want to sell in a premium. And then you have optimal trade entry around about the 0.75, or around the 0.25 if we're buying, around the 0.75 if we're selling. So look how the fair value gap forms on that 0.75 to go down. Look how you've got fair value gap forming around the 0.25 in the discount to go up. Okay, does that make sense? And that's what premium and discount is. It's just identifying any high, any low. So what's happened? Doing it again here just to give you another example. Price moves from discount to premium, back to discount, back to premium. And then you're just making new highs, yeah? But if you were to look at this, then if you're struggling to reach discount price in that below the 0.5, what does that mean? It means we're extremely bullish. It's high like this, low, so this high. That's another dealing range. Price comes into the discount, goes higher. So you can define the dealing range based on where you think price is going to go. So if I'm thinking price is going to go higher from here still, even though we're in premium, you can identify the smaller dealing range, let it come into the discount and enter. Yeah? If $9.30 open, when price comes back down through the gap, so if you go to the opening range gaps add-on, price 75% of the time comes through that, price trades lower at 9.30 open, and this is what you call a Judas swing. So when price trades one way at the open and then it actually goes in its intended direction, that's called a Judas swing, and it happens a lot at that specific time. So make a note of that. The Judas swing at 9.30 is when the price goes in one way and then reverses another way. That's your Judas swing. Let's see if we can spot any more Judas swings. This one just trades straight lower. Here you go. The Judas swing. And through. Judas swing. Down. Not as good of a one. There we go. Judas swing. And down. Doesn't always happen, but you just have to be mindful of it. Judas swing and down. All at 9:30. That's why you don't chase price always at 9:30. This is just choppy. That's the last one. Judas swing and down. So everything's time and price. And the last thing I'll talk about before I end it is that what this price is fractal, meaning that if this happening on the 1 minute chart is the same thing that's happening on the 5 minute chart. And this. Turn the music off for a second. I think detected audio. What's happened in the 5 minute chart is also happening in the 1 minute chart. So you've got multi time frames. So price is fractal. So we can use, for example, the daily chart to highlight, like example, like a fair value gap on the daily chart. Delete these. You should always start on the daily chart and then work lower, because you can see how price respects the levels on the daily chart, but then enter on, say, the 1 minute. Okay, so that makes sense. I'm just mindful this video is getting a bit long now, and I wanted to keep it not too overwhelming and stuff, but just watch this one a couple of times, make notes of it, and then we'll move forward on the next video. Okay, thanks for watching. Hope that was helpful.